Welcome everyone to our YouTube live. So I've just finished watching the FOMC meeting and I've got to say it was pretty much what I expected. So this is really just an opportunity to go over what I take from the meeting and what I think it means for markets, but also to talk about what some of the thinking processes are behind what the Fed's done, because I think that's what you really pick up from watching these meetings, and I've been watching them for a long time now, so hopefully I can give you some kind of insight into that and avoid you having to watch the whole thing. So 1 hour of policy meeting is pretty dry, I've got to say. So the plan is I just kind of recap what I took from the meeting, and then I'll throw it open to questions, and I'll only take questions from YouTube members. So if you're one of our YouTube members, then we'll answer a question, or if there's a super chat, I'll answer that question. So we are restricting it to just those people. So if you want to become one of our YouTube supporters, then you can do that. Just click on the join button underneath the video window, and then you can ask any question you like, or do a super chat. You have to pay for it, but that's another way to get a question. So let's just start off with the summary. I mean, the obvious thing is that they decided to raise rates by 0.75. Now, that's the first time they've done that for 3 decades, so it is very unusual. Now, there wasn't a unanimous decision, so Esther George actually said that they didn't want that. They wanted a 0.5% increase, which was actually in line with what the Fed's guidance had been before the blackout period, just before this meeting. So it wasn't completely unanimous, but everybody but one of the committee members was happy with that 0.75 rise. So they start off with some kind of economic summary to give a justification for what their actions were. So the first point is that economic activity seems to have picked up. There was a little bit of a softness in the first quarter for GDP in the US, but it seems to have picked up since then. And of course, what they're looking for is an economy that's robust enough to weather higher interest rates. And that's what they saw. They also said that job gains have been pretty robust, and the unemployment rate stays very low by historic standards. But of course, inflation's elevated. Currently, it's around 8.6%. And if you adjust for seasonality effects, I think it goes down to 8.5, but still very high. And that they say the reasons for that is a mismatch between supply and demand. So too much demand and not enough supply. And that's related to a variety of factors. And he touched on this again and again through the whole press conference. But the reasons why he thinks inflation's high, obviously it's related to the pandemic. Obviously, it's due to higher energy prices. If you look at the CPI components, very clearly the biggest driver, not just in the US, but globally, is higher energy prices. But now what we're starting to see is a broadening of those price pressures. So not just in the types of prices which are directly affected by the pandemic, but also in the service sector, which is really important for the US economy. Also, things like shelter. You know, the cost of rent, for example, has gone up because house prices have risen a lot. And so that's a big deal for the Fed, clearly. Obviously, some of the factors are outside their control, such as Russia's invasion of Ukraine. That's created huge supply issues for many commodities, oil, but also things like agricultural products and things like fertilizer, which is one of the big exports from Russia, and that could affect global supply of fertilizer, which could have very long-lasting effects on inflation, particularly for agricultural products. And of course, there's also the COVID-related lockdowns in China. That's going to exacerbate the supply chain disruptions globally. And of course, if you haven't got the components to build things, then that can create price pressures as well. So a lot of these factors are simply outside the control of the Fed, and Powell is very keen to stress those. So that's the kind of economic summary. And There was an interesting tweet by Claudia Salm, who talks about the summary of economic projections. Now, remember, this isn't a forecast. This is just what the Fed committee members fill in for their personal expectations for various relevant macroeconomic factors. So, for example, what's going to happen to GDP in 2022, 2023, 24, and then over the longer run. And what they've actually done is they've revised down their GDP expectations significantly for 2022 and significantly for 2023 and a little bit for 2024. So 2023, it's gone down from 2.2 to 1.7. 2024, it's gone down from 2 to 1.9. But the longer run hasn't been affected since their March projection. Unemployment, they also revised that up. So 3.5 to 3.7, it's been revised up for 2022, 3.5 to 3.9 for 2023. So a soft-ish landing, but not quite as soft as they expected in March. Because, of course, the worry is that they raise interest rate, they tighten financial conditions, and it crashes the economy. So they still see a path from here to the end of 2023, 24, when inflation will come back down, core PCE inflation down to 2.3. So that's their expectation. They think it's possible. Of course they do, because that's their job. But I think what's interesting is that the tweet from Claudia Salm says that this less soft landing is not going to trigger the Salm rule. Remember, the Salm rule is based on unemployment. And if unemployment, the rate of increase of unemployment is greater than a certain rate, that's what triggers the Salm rule to imply that we're currently in a recession. And it's worked incredibly well. I mean, it's got no false positives for decades. So it's a very powerful rule for the US to detect when we're in a recession before it actually is announced by the committee that announces these things, the NBER committee. So she thinks that this is still a fairly soft landing, but this is just based on the summary of economic projections. So that's really just a guess by the committee members of the Federal Open Markets Committee. The actual policy statement on how they're going to implement this, part of it's about interest rates, of course. Another part is how they're going to shrink the balance sheet. That part did not change. So they're still saying that there's going to be a certain amount by which they shrink every month. So 30 billion per month will be the cap, and any kind of maturing treasuries will not be reinvested unless it exceeds that 30 billion a month cap for treasuries. And for mortgage-backed securities, the cap is about half of that, 17.5 billion. That means that the total shrinkage of the balance sheet will be about 48 billion per month, and that's about 600 billion per year. So 9 trillion is what we're starting with, and we're going to shrink at about 570 billion per year. So a fairly fast rate of balance sheet shrinkage. But the other point that Powell kept coming back to was that they're going to be nimble. So they didn't expect to raise interest rates by 0.75% before the blackout, but because they had inflation expectations seeming to creep upward, they take that incredibly seriously. Because if they're not credible, if inflation expectations are anchored higher, then the Fed is not credible, and effectively they could lose control of inflation. So they're very much focused on credibility. And so that's really important to the Fed. And so when they saw those numbers edging upwards for inflation expectations, that's probably what tilted them into increasing by 0.75%. The other point, of course, is that inflation was above expectations. We had that in the latest print, and that was also an indicator which pushed them to raise faster than they expected to. So overall, I think his kind of read on the economy was it's strong. It can take greater interest rates. The neutral rate is well below where we are right now. So by neutral rate, what they mean is a rate at which inflation doesn't increase or decrease. and the neutral rate at the moment is around 2% for the longer run. So pretty low, but they're well below that at the moment. So even now, the rate is below that neutral rate. So all they were really doing is kind of getting back to reasonably tight conditions. Now, what Powell said was that they want to end the year at modestly restrictive policy rates, by which he meant between 3 to 3.5%. That's the point at which you're starting to slow down the economy, reduce demand, and that way reduce the number of job openings, and that way get demand for jobs roughly in line with supply. But at the moment, it's still the case that you have 2 open jobs for every person that's seeking employment. And that's a very tight labour market, one which is inflationary. And the wage growth that we're seeing right now is not consistent with wage growth of 2%, was one of the things that Powell was saying. So he said that strong action was warranted, and that's what they delivered. And he also pointed out that they've seen financial conditions tighten. So, for example, if you look at credit spreads, those have widened considerably in the last couple of weeks. Look at the HYG ETF. That's the junk bond ETF in the United States. It's the biggest one, I believe. And the price of that ETF has been plummeting, not just because interest rates have been increasing, but also because credit spreads, which is the probability priced into yields for high yield bonds, of default. So people are just seeing defaults as being more likely now. And we've also seen people actually forecasting that we're going to get a big pickup in defaults in the United States, as all these zombie companies can no longer service that debt. So this is the kind of tightening of conditions which Powell was talking about. And really, they haven't done much yet. They've only increased rates by a bit, and they haven't even really started quantitative tightening, the shrinking of the balance sheet. But even now, markets are doing their work for them. And that's the whole point of forward guidance. They kind of say what they're going to do, markets anticipate it, and that actually amplifies the effect of their monetary policy. So they're quite happy with that. But the goal, I guess, is for monetary policy to go into this moderately restrictive rate by the end of the year. And as always, the Fed talks about keeping things data dependent. So they've been aggressive with their tools. They think they've got the right tools for the job, the shrinking balance sheet, raising interest rates, and they're going to aggressively use them, but they'll be nimble if they start to see a problem. So if something breaks, the credit market, the treasury market, or maybe something to do with liquidity in the treasury market, any of those things would make them step back, I think, from the brink and possibly slow down or even reverse their rate rises, or maybe their quantitative tightening. So I think at that point, I'll probably hand it over to questions. I think that's a reasonable summary of what he said. I think the only thing I'd add is that, there was one interesting point. One more thing, which is interesting, which is you'll always hear the Fed talking about core inflation. So why do they do that? Why do you strip out energy and food prices? Well, of course, they're not doing it because they want to ignore those things. They realize they're important. But if you actually look at what predicts inflation in the future, core inflation, when you strip out those components which are very volatile, is actually a better predictor of future inflation than if you do keep energy and food prices in the number. So it's more predictive of the future, and it is more based around the stuff that they can control. Food prices are affected by commodity prices, which are affected by things like weather. The Fed can't control that. Energy prices usually are exogenous as well. They're controlled by things like the war in Ukraine. So by focusing on core, the Fed focuses on stuff that's predictive of the future and over factors which it can control. But a really interesting point that Powell made was that if you look at inflation expectations by normal people, what makes them worry? Well, it's grocery prices, it's food prices and energy prices. How much does it cost to fill up their car with gasoline? You see that regularly. That's the price you see in the forecourt, in the gasoline station. And the other thing is, when they buy groceries, are they more expensive? So, in fact, inflation expectations are affected by the headline number. And unfortunately, the Fed can't control that headline number. So it's in a difficult place. In order to control inflation expectations, somehow it has to moderate that headline number. But of course, its tools don't really work for that. So a really difficult place for the Fed right now, even more difficult than it is usually. But when he was asked about whether he thought that the Fed could find a path to reducing inflation while not crashing the economy, of course he said yes, he can. What are they looking for? They're looking for several consecutive monthly decreases, or at least a flattening of inflation, as a sign that their policy is starting to work. So that's where they're headed. That's what they're looking for, and that's how they see the economy. So let me just hand it over to questions now. So, as my piece of paper says from Laura, I will answer any questions I have from YouTube members and super chats. So those are the ones I'll answer. So let's turn it over to you. And the first question is from Dan Veneri. Okay. So Dan says, where is the equity market bottom, Dr. Ramin? I'm keeping drip feeding into the market no matter what. Well, the thing is, Dan, nobody knows when the market bottom is. All you can do is look at valuations, and because that requires no information from the future, you'd have to be a Time Lord, and currently valuations are pretty much coming down to neutral, right? So if you look at the forward price to earnings multiple for the US equity market, it's pretty close to fair value. It's about 4% above the 60-year average price to earnings multiple. So fair based on the forecast profits of S&P 500 companies. Cheap? No. So it's not cheap, it's just at fair value, assuming those forecasts are correct about the future. If you look at another measure, like the excess cape yield from Robert Shiller, which looks at interest rates and factors those in, the reason why that's not looking cheap, it's looking a little bit expensive, is because real interest rates, so that's the 10-year Treasury rate adjusted for inflation, that real interest rate has been surging upwards so far this year, more quickly than valuations have adjusted downwards. So by that measure, equity markets look expensive in the US still. And if you look at CAPE, for example, that's at 29 times the multiple, which is still well above the average, which is around 16 to 20. So really depends on which valuation measure you look at. But I'd say, Dan, that, I think, valuations may have further to fall. We're just at kind of fair value now, but for other measures, a little bit expensive. And if you look at the excess valuation of things like FANG stocks, FAMG, I can't pronounce it, FAGMAT, I don't know what the acronym would be, but Facebook, Apple, Alphabet, Microsoft, Netflix, I'm struggling here, Tesla. If you look at those stocks, they're still valued above the general S&P 500. So the S&P, I think, is on an average multiple of about 16.1. And those lot are at a higher multiple, about 22, 24. So there's still an excess valuation for those really big stocks which dominate the US equity market. And I think that probably has to compress further. Also, small cap growth still looks relatively expensive compared to small cap value. So, I still think there's a bit of euphoria priced in. Are we at the equity market bottom? Nobody knows. But at least now you can buy equity in the knowledge that valuations are lower and your returns will be higher. So that's good for everybody, right? So don't forget, don't panic. Cheaper equity markets, a buying opportunity. not a selling opportunity. So it's great that you're drip feeding, Dan. Next question is from Stephen J, also a supporter, a YouTube supporter. We can tell because he's got a crown next to his name. Do you think the stock market will go down much further? Oh, very, very similar question. Do you think yields will stop going up from here and it's time to buy TLT? What happens if the Ukraine situation gets worse? So 3 questions. Okay, so first one we kind of dealt with about the stock market going down. Nobody knows. Valuations, pretty reasonable now, much more reasonable than they were, certainly. Do you think yields will stop going up from here and it's time to buy TLT? Well, I mean, I was thinking about this recently because for my fund portfolio, I was thinking, well, you know, maybe now's the time to buy long duration US Treasuries because they have sold off so much. I mean, about 25% year to date for TLT, for example. But what could drive them higher is if, say, for example, growth surprises on the upside. What if we did have better than expected growth? Well, in that case, yields would rise. So that is a kind of worry if you are long US Treasuries, particularly long duration US Treasuries. But the risk reward now is a hell of a lot better than it was at the beginning of the year, because a lot of growth is already priced in to that long end of the yield curve. And I think growth may actually disappoint going into 2022 and then 2023. And if that happens, usually yields fall as bonds rally. So I think if inflation fell or if growth surprised on the upside, then growth disappointed. So if growth disappoints or inflation starts to fall faster than expected, that'll be a big positive for long duration US bonds, both of which are possible now. You know, I think the risk reward is much better than it was, that's for sure. So, you know, I'm thinking about it, but I'll wait for yields to stabilize before I do that. So I'll miss out on 10% of the gains, but I probably only do that once I saw real evidence of stabilization. And this is such a volatile market for fixed income that I really wouldn't take that risk right now until I see some evidence of stabilization. So next question is from, same person. So what happens if the Ukraine situation gets worse? Well, I guess some of the supply of oil from Russia, which is still ongoing, of course, they're still making around $1 billion per day from their oil sales, Russia is. So if that starts to fall, if the production starts to fall, which is possible, then, you know, that would push up commodity prices further, that would push up inflation further, that means a more aggressive Fed and a slower economy. So it's not a great story, I've got to say, if the situation in Ukraine gets worse. But I think what's looking likely is some kind of stalemate. I think it's looking as if eventually there's going to have to be some kind of political solution, but it seems as if they fought each other to a standoff for now. It seems as if Russia is gaining ground, certainly in the eastern part of Ukraine, but it's looking like it'll be a really protracted conflict, which may last years. It's possible. So I think that's probably the worst outcome, because remember that while we're worried about inflation in the West, people in North Africa are worried about eating. And a lot of the grain that would have come from Ukraine would actually have just gone to feed people in the Middle East and North Africa. So there could be starvation in those countries and political instability, which often comes from hunger. And so that's the real problem, which I think people really aren't talking about much. I mean, we're much more concerned about inflation, you know, how much our fuel prices are, how much, you know, we're paying for mortgages, you know, that kind of thing in the West. Whereas, you know, they're worried about just living, you know, just eating, having enough to eat. So I think that puts our worries into context. But I think that would be one of the awful things about the Ukraine conflict going on for a long period of time, which would be that political instability and the starvation that would follow. Yeah. Right, so back to any other questions. So I don't think we have any other questions, so I'm not going to belabor the point and kind of extend this beyond beyond the half hour if we don't have any other questions. But if we don't have any other questions, I'll just wrap it up there. And I just hope that was useful. If it was useful, I mean, I could do this again. You know, I kind of like watching the meetings. I have to do it anyway for the weekly market roundup. And if you haven't signed up for that, do, because I discuss this stuff in that. And the other kind of thing I'd say is that I think these kind of macroeconomic factors really do affect markets at the moment. So if we look at the market action today, you can see when the FOMC meeting started, because there's just a huge volatility in all the risk assets, the NASDAQ, the S&P and bond markets. And really there isn't a clear outcome. They've rallied slightly. So the NASDAQ is up 2.5%, high yield bonds, HYG, up 2%. The S&P is up 1.4%, but still nothing absolutely resounding. So I think, you know, inflation's high, the Fed is credible, and the US economy is still kind of okay. So for now, at least, I think it's pretty much a status quo. There was nothing new there. And the 75 basis point hike didn't really freak out markets because it was kind of leaked by Nick Timraus of the Wall Street Journal just beforehand. So not a huge market reaction so far, but it often takes a couple of days for markets to digest this kind of new information. And we'll just have to see how we pan out with quantitative tightening, because that's just beginning. So if there aren't any more questions, I'll end it there. Thank you all for joining us. And don't forget to subscribe, and don't forget to join our membership, because then we could discuss this one-to-one, or you could have a one-to-one coaching session with me. All of that's on the website. Just go to PensionCraft.com. So have a great time, everyone. I hope markets work out for you, and that let's hope that the Fed can steer its way to reduce inflation. Take care, everyone. Bye-bye.